Welcome, Joyce, to Retire into the Stock Market Session 4. How are you?
I'm good. How are you?
Good. We started talking about the Dow Jones, how it's going higher, and the Dow Jones is 33,389 today, plus 74. It's also behind me, and the high. We know the high for the Dow Jones. We looked in December, and it was about 37,000. So this is important to keep track, because if it hits 37,000, as you can see, it's going up. That we've broken an all-time high, and the market is going to be at an all-time high, going higher and higher. This is what we're looking for: trends down, up, sideways, right? So we'll keep track of the Dow Jones every week, and we'll see it move up and down. And the theory is that if you have the good stocks, right, that at least match the Dow Jones, which is the top 30 stocks, then you're going to have similar results. Okay. So in this case, they're going up. It was up from last week. It was up from the week before. So we're on a trend going up. That's important. So you want to have the great stocks, or at least stocks that are equal to the greats, to have a meaningful gain when the market goes up in the uptrend. But if you have awful stocks, you'll notice that they don't really follow the trend. So if you have really bad stocks and the market's up, you probably haven't made any money, because, like I said, if they're bad stocks, they're not going to really go up or follow the trend. But if you have great stocks, they tend to follow the trend of the Dow Jones, the S&P 500. And like I said, we want to pretty much choose the S&P 500 for our selections. So that's a good way to start, because that way we know that they're accomplished, that they're real companies, that they're monitored, they're covered by these other stock market indices, and they're valuable. Okay. Now you asked me about Plug. So I looked at Plug. The first thing I see when I pull it up, I see it has a price of 28.02, down 77 cents. That's no big deal. The volume is 25 million. Okay, and I have an EPS of minus 97 cents. So that means they're losing 97 cents per share. Okay. Now, the PE is dash, or zero, which means they have no PE, they have no profits. Okay. So that part is pretty bad. Okay. Now, we're hoping that will change, that will go up to a profit, but it may not. It may be that they're going to stay at a loss. Amazon was one of the few companies that was operating at a loss for a long time, but what they're doing, they're growing at such an exponential rate that they can explain the loss. They take all their revenue and they reinvest it into infrastructure, and that way the company can grow. And I don't know what year they caught up and they started making profits, but once they started making profits, the stock really took off. So that's Amazon. However, few companies can be Amazon. Matter of fact, probably no companies can be Amazon. So just because Amazon can operate at a loss doesn't mean another company can do it. Okay, so we want to see a gain. We want to see a positive PE. We want to see a positive EPS. Okay. And then if we look at the market cap, I have 16.56 billion, which means that the whole value of the company, and the whole value is 16.5 billion, and that's comes from the share price times the number of shares. Okay, I'm gonna explain to you how you can get the number of shares. In this case, for Plug, so you take the market cap of 16.56 billion, then you divide that by the share price, 28.02. Let me do that now. Okay, follow along. Okay. I go to my calculator, I turn it sideways because we want the billions. This is the Apple calculator, just a basic way to come to your phone. So I put 16560 16.56 billion divided by 28.02 equals. Okay, so I get 591,006,423 shares. Okay. Now, what that means is they have 591 million shares times $28 a share is 16.56 billion. You see that? Now, this can be meaningful in the sense that if their EPS is minus 97, that means that they're losing. Let's say round that to $1, right? Just round it to $1.97. So they're losing $591 million per year. Okay, so almost like halfway to $1 billion. Okay, so what we're gonna do, we're gonna look at this. We're gonna see if it's consistent, if it's getting lower. We're gonna look at the share price and look at the performance of the stock price week to week, for example. Then we're gonna see if we can get any kind of meaningful number out of this. I'll tell you how to do it week to week. But for the most part, what we're seeing is that they're losing, more than $500 million per year right now. As it stands. That part's bad. Let me see what else I see with the plug. I know they don't have dividends, so just write that down. No dividend. Look in the corner. The corner bottom right says yield. YIELD is 0%. That's per year. So no dividend, right? And let's just stay with those. Let's just stay with that number. And then we're looking for cover call, CC, put CC, cover calls.
Where are you looking for that?
Because we want our investment to be able to give us cover calls. That way we can make money on the cover calls, right?
Where do you look for that?
I'm going to show you right now.
Oh.
So you go into your TD Ameritrade Stocks app. Okay, I'm gonna go into mine.
Oh, so you can see it.
Doesn't the cover calls don't show on the basic app? Okay.
Oh.
You go into search, put plug PLUG. Okay. Now on my stocks app, I have a little bit more information. I have a chart. I have a picture that says a screen that says chart, news, and options. Okay. I'm gonna send you a picture. Okay. See there? All right. I'm gonna send it to your phone. So this is the basic screen. It says chart, news, and options. Now, chart is of course the stock chart. News is you can look at the news articles, and the options are the one we're gonna press. Press options.
Okay.
And we're gonna go to the option chain. Write it down. Option chain, which is options. Every stock has maybe like 1,000 options. Depends on the stock. But we're gonna look for this one. Since it's August, we're gonna look at September. Okay. So click September 16th. Can you do that?
So I need to scroll all the way down.
Well, it's not all the way down. It's halfway. September 16th. It should show 100. Okay. And then we're gonna go in the middle is the strike. Did you click it?
Okay, I went to the September 16th. I see the bid is 22.90, the ask is 23.
I'm sorry. Is there a way you can talk a little louder? I can't hear you. Put the microphone right to your mouth and please articulate. When I click on the bar that says September 16, 22, it says 36 and it says 100. Okay. You have a middle row that says strikes, and the strikes are the strike. That's the option strike. Okay, so put option strike. Now, if I put 30, if I put 30.
Oh, do you hear me?
You said you're lost.
Can you hear me?
Yeah, can you hear me?
Yeah. So I went on the September 16th. So I don't see the 100. Are you talking about in the middle where this is strikes, the 24 strikes on mine?
Yes.
One side is calls and the other side is puts.
Right. We're not doing puts today. We're doing calls. Okay. So in the middle is the strike. So go to the 30 strike. The 30 strike says 1.77 by 1.81. You see that?
Mine says 1.76 and the
That's
asking
fine. That's fine.
is
That's fine.
178.
That's fine. So you can look at the bid. The bid is the left and the ask is the right. So the bid.
The bid is the bid is the what?
The bid is how much you get paid for selling, okay?
Mm-hmm.
And the ask is how much you have to pay for buying, okay?
Mm-hmm.
So if you were to buy the option, for example, you'd have to pay 181, which is $181 per contract, okay? So, but we're selling, right? So we're looking at the covered calls. Covered calls are like I'm sorry, I'm not here on my patio, this car is going by. The covered calls are probably arguably the best strategy in the stock market. And because you own the stock and you're renting your stock to the public and you're getting money every month. That's why. So even though it's a small amount of money, it's a consistent money. That's why it's good. I'm going to show you right now. I have 180 right now. I know it's going up and yours is a little different, but we're going to use 180 for the bid, okay?
Okay.
That means that we're going to get $180 for every 100 shares of plug, okay? That's what that means.
Okay.
So we're going to get $180 for writing the cover call, right?
180 per what? Oh.
You understand?
Yeah.
If we write the cover call on the bid is we're going to sell. So we have the shares. We're going to sell the cover call. So put sell and then put in parentheses right. WRITE, right. Right cover call. And here it's 180, which is $180, okay? Now that's for 100 shares of plug. So 100 shares of plug will cost us how much?
Say that again.
100 shares of plug will cost us how much?
It's going to be $180.
No, that's not right.
The what?
One share of plug costs how much?
Oh, $28.
That's right. 100 shares of plug costs how much?
2,800.
Correct. If we write the cover call for it's August, so we write September. How much are we getting?
For oh my gosh, that's gonna be like
We just went over it.
180
right,
for 100
$180.
shares.
Right. So this is the way. So now we're gonna. So the picture you put in the investment for $2,800. We're gonna get back $180 every month. That's what you're thinking about right now. Okay. So we need to turn that into a percentage. Okay. This is how you know if it's good. Right. So what we do 1.80 divided by 28.02. That's how we do it. Let me do the math. 1.80 divided by 28.02. Follow me? I get 6.423%. All right. Now that's a great percent. It's a great percent return. All right. So the result from this is plug does have good cover calls. You know, like if you had $1 million, here, you had $100, you got 6% return from that $100. What's your return?
6%.
Right. What's 6% of $100?
$6.
That's correct. So now let's say you have $1,000. What's your return on 6%? If that is zero.
$60.
That's correct. Now let's go to $10,000. What's your percent return? At 6%.
That's $600.
Correct. Let's go to 100,000. What's your return?
If I have what?
100,000.
100,000.
We're gonna keep going. We're gonna go to $1 million. Okay.
Oh, okay.
What's your return
6,000.
at 6%? That's correct, 6,000. Now, let's say it had $1 million. And you know, over a lifetime, you know, a lot of people can get $1 million investment, especially if they have their 401k or their pension, right? Or just savings over time, you can get that much money. And if you have $1 million, you're getting 6% return. What's your return?
If they have how much?
$1 million at 6% return. Just add a zero from the last one.
$60,000.
That's correct. And that the reason that's meaningful is because you can live off that money. That's why. So $60,000. And how often can we get this return?
Every month?
Every month. What we did, we took the stock, which is 28, and we wrote the cover call for the next higher up strike price. In this case was 30. And that gives us room. It gives us room for the stock to grow. Like if you have a stock that's 28, I don't want you to write the 28 cover call. It's going to give you more money, but it's not going to give you any share growth. I want you to have some share growth and some money, both. So that's why I wrote the 30 and not the 29 or the 28. Understand? So when we do a cover call, we're going to write the cover call above this. Write it down. Right? CC above the stock price. Now, how much above? I'm going to get into this more and more every week, but if you can get the basic steps, to buy the shares, 100 shares, write the cover call. In this case, we're going to buy the shares at 28, write the cover call at 30, so you get 128, which is $180, which is, to buy that amount by the share price is 6.423%. So I say 3% to 5% is good, okay? So 6.42% is excellent, all right? And the reason why that is because for Plug is because it's a very volatile stock. A lot of people are trading it and it tends to move a lot, that's why. So just because that amount is very high, it doesn't mean it's a good stock, but it does mean that they pay us a good amount for cover calls. Follow me?
Mm-hmm.
Now here's the thing. I want you to take a good stock. I want you to write 10 cover calls a year. This is the basic philosophy, all right? I don't want you to do it every month. I want you to do it 10 times a year, okay? And if we're doing 6.423% per month, we do it 10 times. What's our return at the end of the year? What percent is our return?
At 6.4%?
Yes. Times 10 times. What's our return?
10 times is 60%.
64.23% return. Okay. Now, that is what you call income. Because we're getting premiums, which is the premiums is another word for the option price. When we sell the cover call or write the cover call, we're getting income. And that's one thing. But we also have to look at the share price. The share price is 28, okay? That share price also has to maintain. If it doesn't maintain, then we're getting income, 6%, but the share price comes down, our investment comes down, right? So keep in mind that just because you did a cover call for 6% on 1 month and did 10 of those in the year, 64%, doesn't mean that that's the final result, okay? Because the stock price, what's the stock price went down to 20, okay? You see, you can have a loss of the stock price, even though your cover calls are good. So the point is even though it says you're getting a 64% return a year, let's just lower that amount because we want to have a goal at the end of the year that to have a return on our investment. Let's just lower that amount way down, let's say that 40%. Okay, so put 40%. 64.23% return. Put 40% goal. So the 40%. So the goal is 40%. So we can get 40% and Plug, that'd be great. Okay. Now, that said, I still don't like the stock really. I mean, it doesn't have profits. Does it have a 10-year chart? We look at the chart. Is it a new company?
It does have a 10-year chart.
It does actually. It shows here it went all the way up to $200. Probably because when it started, $1,000. Went to $1,000 when it started.
What did you say?
Down. It went to $1,000 when it started. If you click all on your stock on your Apple stock app.
No.
Click all. And back in 1999, it was at $1,100 a share.
That's true.
And it's bad because it went down. Because think of the people who bought Plug in '99 for $1,100 a share, all the way down 50, 40, 70, 50, $9, $1. Went to 17 cents, 16 cents back in 2010. Okay, $1, $2. Now it's back up to 27. So it looks like it had this long trend where it was going down. Now it starts to go back up. So the 10-year chart is no good. Okay. What you want to do is a 10-year chart that's going up over 10 years. Okay. This one's still going down. Okay. Now, can you pull up Coke, KO, or PM?
Can you do what?
Coke. Can you pull up Coke, KO on your Apple? Your Apple stock chart.
I'm
gonna send you a picture of what I have. Coke, if you look at the stock chart 10 years ago, it was at $39. It goes up to 63. It almost doubled in 10 years. Okay. Send you a picture. Save all these pictures. I'm gonna send you a picture.
Okay.
This is what I'm looking at. Okay. Keep in mind that a good company with profits will have a good 10-year chart. Most of them do, anyways. You see how this one's going up? Now I'm going to show you Plug. I'm going to show you the opposite. Okay. Plug is not doing great. Plug 10-year chart is going the wrong way. Actually, the 10-year chart for the 10-year chart is looking a little better. Okay, but it's still not great. I'm going to send it to you. Save all these pictures. So what I got is 10 years ago, the stock was about $1.05, and it kind of goes up and up. It doesn't really, I mean, it does go up. It goes to 68 back in 2020. That's probably when the pandemic hit. Now it's back to 38. It's at 28. So this is not a good chart. Like I said, they don't have, like, look at what they have, right? They don't have profits. They do have the volume. Here, let's write this down. Volume, check. And they have covered calls. Check. Volume, check, covered call, check. 10-year chart, X. They don't have that. PE, X. They don't have that. Dividend, X. They don't have that. What else do we check? Market cap. The market cap is one of the factors. MC. Market cap is one of the factors. It's 16 billion. So we want to have a stock with a market cap anywhere between, let's say, 15 and 25 billion, which is like a good amount of market cap for that can sustain growth, right? So right in the market cap, put a check mark. They do have the market cap. Market cap is in the right field. So they do have volume, covered calls, and market cap. They don't have 10-year chart. They don't, which is X. They don't have PE, put an X. They don't have dividend, put X. We can do a few more. I don't want to overwhelm you, but there's stock splits.
So I have a question.
Yes.
So for me to do a covered call, that means I have to own the stock, right?
Yes, 100 shares minimum. Yes.
And then when you're going to the options, you need to be selling.
Yes. Yes.
And so I need to go with the bid.
Yes.
And then
And
when I
you
sell,
sell at market.
I sell a market and
Yes.
then just keep it there.
Yes.
It's like
Exactly.
I'm holding it.
Yes.
So I have to be confident about that company that will be giving consistent.
Any company that we decide to do cover call, you better feel confident, because all of the, even the good companies will come down, right? And if you're gonna do a cover call, then you're gonna expect you're gonna hold that stock for at least a couple months, you know.
Is there a minimum time you should hold a covered call?
It depends on your philosophy, but I would say if you're doing cover calls, plan on keeping the stock for at least 3 to 6 months, you know, and ideally for a year, because that way you can get, like I say, do 10 cover calls a year, see how much money you can make, and look at your your profits and see if they hit your goal, see if they're meaningful. Well, let's make meaningful profits all the time.
So like if I go personal with you, which one have you held for the longest?
I have Philip Morris for like almost 30 years.
Wow.
And that one has great dividends. And that company actually split in two. I'm gonna say I forget what year that happened. But it's still Philip Morris. There's two. They're thinking about going back together. There's two. There's an MO and there's a PM. They're both Philip Morris. They split. One is US and one is worldwide. So they're thinking about coming back together into one again. It's just stuff for legal reasons. I've had Netflix for more than 10 years. I've had Twitter. Well, I don't have Twitter anymore. So I sold most of it. I had that for, I was doing cover calls on Twitter for about 10 years, maybe no less. But I don't think about, what stock maybe the most money, because I'm thinking about presently. Like presently, I have a core 10 stocks list, which means I have the top 10 stocks I have on the list, and I trade those. I stick with those 10, and or fewer. And I switch those out every few months. Maybe I'll trade one, maybe not. And I couldn't tell you how much money I made at Philip Morris. I couldn't tell you all the dividends. They pay dividends every quarter, So if you want to take 30 years times 4, it's 100. So I had 120 dividends on Philip Morris. So figure out how much that's going down on, how much that is. And then the stock has gone up also over time.
The stock has what?
Gone up over time. But if you, so that's share growth. That's like a dividends, like a share growth. But I have these other stocks like Netflix and Twitter, and that I've been doing cover calls on. And I probably made more money on cover calls than anything else. So that can add up. Like if you're getting $180, right, a month, that's going to add up over every month. If you have 2 contracts, 200 shares, right, that's $360, right. So I would say it's nice to have dividend stocks. It's nice to have share growth stocks, which is great. But for the sake of our training, you want to have that. Plus, you want to have cover calls. I'm gonna say cover calls probably the most important positions, because that's going to give you more meaningful money, and it's going to kind of get you into like a trading mode where you feel comfortable you can trade stocks. Most people don't do cover calls. That kind of separates you from the average investor. Average investor, honestly, they just buy the stock and they hold it. That's the average investor. Cover calls is a more advanced strategy, right? So that part is good, and that part's worth you doing this course and me teaching you, and you doing it. Then there's options. There's more high level options. We can get to that later, but hello. Okay, so there's 10 criteria. I'm gonna go over them just briefly. We did 1, 2, 3, 4, 5. So we did 6. I'm gonna do 4 more. Volume, cover calls, market cap, 10-year chart, PE, dividends. There's stock splits. There's all-time. Write this down. All-time high. Okay, all-time high. There's stock splits. Then there's share price. Okay, that's 9. There's one more. Or can it double? Can it double? So that's 10. So to repeat, right, all-time high, right, stock splits, right, share price, and then right, can it double? So that's 10. So the 10 criteria are volume, cover calls, market cap, 10-year chart, PE, all-time high, dividends, stock splits, share price, and can it double? There's 10. And we're going over plug. You asked me about plug. I'm telling you what we have. I don't think they've had any stock splits, but maybe they had. Let me see. I'm gonna go to stocksplithistory.com, right?
Stockhistory.com?
Stocksplithistory.com. Stock
Oh,
split history.com. Now, I don't like you to go to other websites, but this is one that I use. Okay, so I'm gonna put plug here. You go to search. It's a simple plug. Probably it has stuff. Plug has had 0 stock.
you went to home and then?
Those stock history, it's like a yellow bar, right? And then you put search, you put the symbol PLUG, and then it shows you the plug has had no stock splits, 0. So if you put an X, no stock splits, put an X. So like I always teach, like, stock splits are very good because you have a stock split. That means that the stock has gone up and up so high, and then they're going to split the price downward to attract more investors. And what happens after that, it tends to go back up.
So it shows the yellow stock split history. Then there's the discover funds for investing. There's that little box that's white.
And
I'm confused where to
what's
go.
your question? What's your question?
Is it supposed to look like this?
Yeah, but we're not clicking on that. All we want to know is if it has stock splits. You understand?
So where do you go after that? After you put in the...
No, listen. Okay, look. A stock split means that the company splits its shares, okay? This is a qualifying factor for our stock selection. We have 10 qualifying factors. I just went over them. So when you go to stockhistory.com, we see if the company has had stock splits, yes or no. And in this case, the answer is no, okay?
So where did you get the information?
That's it. That's all you look at. Type in the search plug. It'll tell you. Type in plug.
I guess I'm in the wrong place then. Split
Go to search and put plug. Take your time.
I think I'm in the wrong.
Just go to search. You see, you're on stocksplithistory.com, right?
Yeah, stock. Yeah.
Now go hit the three black bars on the top left.
Okay, and then
you should get a search bar.
Oh, okay. And then I hit
put in plug, PLUG.
I'm gonna say done, and then doesn't give me anything. This is what it brings me. Yeah.
Did you put plug? Top left. Click the top left.
I did. I went there.
And you put PLUG.
Yeah, I entered the symbol PLUG.
Okay, so what I get.
And I say done.
Okay. So scroll down. See, here's the thing you gotta understand. Okay. And this is why I don't want you to go to websites. Websites are littered with ads, with like these scams and these sales gimmicks. Okay. That's why I don't want you to go to other websites. But if you scroll down, I'm telling you how to use this website. It'll tell you Plug Power has had 0 stock splits. You have to read that
Okay.
back to me.
Okay. It
You see
says
it?
plug. Yeah, it's in white. You couldn't even tell because it's not in bold.
Because that's because they littered the top with ads and gimmicks. Okay.
Yeah.
Now I want you to do one thing. Go back to the 3 bars. This is important. Look at the
Okay.
3 bars, and for symbol, put Apple. AAPL. Okay.
AAPL.
Yeah, and ignore the stupid gimmick on top and scroll down. And tell me how many stock splits Apple's had.
Has 5 splits.
Yes, 5 splits. Now go back up to the 3 black bars and put Netflix. NFLX. Tell me how many splits Netflix has had.
2.
Right. Now let's go back and let's do Coca-Cola. KO. How many stock splits does Coca-Cola had?
9.
9. Let's do Starbucks. SBUX. How many splits does Starbucks had?
6.
Okay, so I'm telling you, take a stock, go to stockpicture.com, see if they have stock splits. This is one of the key factors for selecting stocks. Of course, a new company is not going to have stock splits, right? But if they have stock splits, that's a bonus, right? It's like a lot of companies don't have a dividend, but if they have a dividend, that's a bonus. It's better than not having it. Okay, so these are different factors. I can explain to you all these factors in detail. I would write a book on each one, but for the point of this course, I'm going to condense it for you. You gotta trust that I'm giving you the right information, and you're going to use it. You're going to use it, and you're going to have a result. Okay, that's it. Use information, you have a result. So stock splits, put X, none. We have all 10 here. All-time high. So all-time high means you buy the stock when it hits the all-time high. Okay.
Mm-hmm.
So that one is the X because it's not at an all-time high, it's at $28.
Mm-hmm.
The share price qualifier is you want to have a stock that's $100, $200, $400 plus. Okay, like Tesla is $800. That's a qualifier. It's a high share price. Why is a high share price important? Because a high share price has gone up and up and up over time, and it's proven itself by going up. That's why it's good, because it went up and up, and it's a high share price between $100 a share and $200 or $400 a share. Plug is $28. That's too low. So no. Okay. X. Can it double? Hang on.
Hello. Hello.
There's a truck that came by my street. Sorry. Okay, so Plug, it does not have share price is too low. So X. And now the question is, can it double? This is the last qualifier. The way you know if a stock can double is if it has doubled in the last 3 to 5 years. Okay, so go to your Apple app, click on Plug, then click on a 5-year chart. Has the stock doubled in 5 years? I would say it has actually. It does because 5 years ago it was at $1, $4. What if it's 68? Now it's at 28. I would say yes, it could double. So now it's a check. So has a volume check? Has cover call check? Has market cap check? Has 10-year chart? No. PE? No. All-time high? No. Dividends? No. Stock splits? No. Share price? No. But it can double. So it has 1, 2, 3, 4 of the 10 criteria and 6 no. So in a basic sense, I would say Plug is a no. You want to have at least, I'm going to say at least 6 to 7 or 8 of the top 10. Now, that said, if you want to try doing Plug maybe for cover calls, that would be fine because it's a $2,800 investment. You did too. It's $5,600. They do have some things going on. I would say it's an average stock. It's not better than Twitter. It's not better than these other average companies, but it does have some things. Maybe they think in the future it's going to turn around. Great, But I would say it's just average. It's not great. But if you want to do a couple of calls, I say that's okay. So what do you think about it, okay?
Mm-hmm.
Now, questions. Questions. I don't want to leave you with any questions. You find out how to do stockhistory.com. You can put your stocks in there. That's important. We looked at the 10 criteria. We covered everything. We did plug. We got 4 out of 10. Not great. But a few things are okay. We went over the Dow Jones going up. We went over if you have good stocks, your stocks will go up at the Dow Jones for the most part, not always. We talked about writing 10 cover calls a year on a good stock. That's for income. We talked about 6%, what that means for $100. It means $6. What it means for $1 million, it means $60,000, right?
Mm-hmm.
Questions. We pulled up the option chain and we figured out how much the stock will pay us for writing cover calls. Write this down. Write this down at the bottom of your notes. The option chain. The option chain is your paycheck. Okay?
Mm-hmm.
Option chain is your paycheck, right? Okay. We covered a lot. I want you to review this, rewrite the notes. I want you to think about having a core 10, getting 10 stocks that are great. I don't know what I gave you last week, but I'm going to give you a couple to look at, okay?
Uh-huh.
Let's look at AMD, Advanced Micro Devices. We talked about Tesla, TSLA. Tesla's going to split this month for a 3-for-1. So you might want to get a few more Tesla, but I know you have some, so that's fine. Apple, AAPL. We took Netflix and FLX. You can put plug in here, PLUG. And let's get one more. Let's get a dividend. IEP. Ingrid, Eric, Paul, IEP.
What do they do?
Agree with that. IEP is Carl Icahn's company. Carl Icahn is a billionaire trader, and he basically manages money. He manages. He takes 20% off the top, and he gives his investors whatever else he can make. So he's like a money manager, Carl Icahn. So basically, it's an investment company, IEP, and they pay a dividend of 15%, 15% dividend. And I'll tell you, it'll be difficult for you to find a dividend company that pays that much consistently, or impossible. So that's one of my favorite dividend stocks. If you buy one share of IEP, it pays you $2 per quarter. Okay, so one share is like $50. It pays $2 every quarter, so $8 a year on that one share. 100 shares, you'll be getting $200 a quarter and $800 a year on that one share, and that's 15% dividend. Write it down. IEP. Look at these stocks. Do your homework. Look them, compare them to our criteria. Okay.
Mm-hmm.
We covered a lot. I don't want to overwhelm you, but that's good because every week I want you to learn things, and then we review, and then we start using this information. We start trading. I'm happy that you sold some of your weaker stocks and we bought Tesla. So consider doing more of that. If the investment's not making you money, you gotta be willing to cut it. We talked about Mr. Morgan. He's a man from Texas. He has old money. He doesn't trade. He hires traders like you. He has a big building, which people go in there and trade. They manage money, and if you can't make money, you get fired. That's it. So he doesn't care about what you think about the company. He just needs your account to make money. If you can't make money, you get fired. So think of it like that. It's a business. It's not a charity. Okay.
Mm.
Where we're responsible. We have money. We're responsible to make money, to make good investments, right?
Mhm.
That's right.
Gotcha.
So always think about, you work for Mr. Morgan, and think about how your investments are making money. If they're not, you gotta consider getting rid of it. And then maybe exchanging it for a better, more profitable stock. Sound good?
Okay. Okay.
Thank you, Joyce. Let's continue next week. Sound good?
Okay. All right. Okay. Thank you.
All right.